What if the safest investment everyone keeps recommending is quietly draining your future wealth right now, and almost nobody notices until it's too late? Yeah, that sounds dramatic. But stick with me for a minute, because this might be one of the most important money conversations you hear this year. Imagine a regular person, hardworking, playing it smart, doing everything the responsible way. They save money, they avoid risky moves. They choose the so-called safe asset everyone talks about at family dinners, in finance blogs, even on TV. Sounds smart, right? That's the vibe most people have. Safe equals smart. Safe equals responsible. Safe equals peace of mind. But here's the twist nobody likes to say out loud. Sometimes safe doesn't protect your money. It slowly erodes it, not in a loud, dramatic crash. No headlines, no panic, just a quiet leak, year after year. And by the time people realize it, a decade is gone. Let's break this down for real, because this mistake is crazy common. When people think about investing safely, they usually picture stability, something that won't swing wildly, something predictable, something that lets them sleep at night. Totally fair. Nobody enjoys watching their account balance bounce around like a roller coaster. But here's the catch. The world keeps moving, prices keep climbing, and economies keep shifting, whether your money moves or not. If your investment barely grows or grows slower than inflation, your buying power quietly shrinks. Think about it like this. 10 years ago, a certain amount of money bought a lot more groceries, gas, and rent than it does today. Now, imagine parking your savings somewhere that barely grows, while everything around you keeps getting more expensive. That safe move suddenly starts looking a little different. Not scary on the surface, but quietly expensive. Experts talk about this behind closed doors all the time, not because the assets themselves are evil or useless. They have their place, but because people misunderstand how to use them. They treat them like a long-term wealth engine, when in reality they're often designed for stability, protection, or short-term parking. Big difference. And that misunderstanding costs people years of financial progress. Here's the part that surprises a lot of folks. The biggest risk in money isn't always losing a big chunk overnight. Sometimes the real risk is losing small pieces slowly while feeling comfortable the entire time. It's the financial equivalent of leaving a tiny hole in your pocket. One coin slips out, then another. You barely notice, until one day you reach in and realize most of your money is gone. Sounds harsh, but it happens constantly. And here's where psychology kicks in. Humans love certainty. Our brains are wired to avoid pain and protect what we already have. So when someone says, "This is safe," it triggers relief. That feeling alone makes people stop asking deeper questions. They don't check long-term growth. They don't compare opportunity costs. They just park their money and move on with life. Totally understandable. But the market doesn't care about comfort. The market rewards growth, productivity, and time. And time is the real game here. If your money grows slowly for 30 years, the difference between average growth and strong growth becomes massive. We're not talking about a few dollars. We're talking about life-changing gaps, retirement gaps, freedom gaps. The kind of difference that decides whether someone works because they want to or because they have to. And here's the ironic part: many wealthy investors actually use safe assets to. The difference is timing and proportion. They don't treat safety as the entire strategy. They treat it as a tool. Sometimes it's used to protect capital temporarily. Sometimes it's used during uncertain markets. Sometimes it's used after wealth has already been built. But beginners often flip that strategy upside down. They start with extreme safety before growth has had time to work. It feels disciplined, but financially it's like planting a seed and then refusing to give it sunlight. Growth needs oxygen. Growth needs time. Growth needs exposure to productive assets. Without that, wealth moves in slow motion. Now, don't get this twisted. This isn't about gambling or chasing hype. The internet is full of people yelling about overnight riches. That's not the move either. The real lesson here sits right in the middle. Understand what your investment is designed to do. Stability is not the same thing as growth. Protection is not the same thing as wealth building. And confusing those roles is where people accidentally stall their financial future. Think about the stories you hear from older generations sometimes. You'll meet someone who saved consistently for decades, did everything right, stayed ultra safe the entire time, and still ended up with less financial freedom than expected. Meanwhile, someone else invested in productive assets over the long term and let compounding do its thing. Same starting line. Very different finish. That difference is rarely about intelligence. It's usually about understanding the job each asset is supposed to perform. Another thing experts quietly point out is inflation. Inflation is like gravity on money. It's always pulling down your purchasing power. If your investments don't grow faster than that pull, your real wealth shrinks, even if the numbers on your account statement look stable. And that illusion tricks people. They see the same balance year after year and think, cool, nothing bad happened. But behind the scenes, that money is buying less and less. It's subtle, but powerful. That's why some professionals say the scariest portfolio isn't the one with volatility. It's the one that never grows enough. Volatility, at least, gives growth a chance. Stagnation quietly locks in mediocrity. And let's be real for a second. Nobody grinds through years of work just to end up financially stuck. People want options, time with family, less stress about bills, the ability to say no to things that drain them. Money isn't everything, but financial freedom changes how life feels. It gives breathing room, and that breathing room usually comes from growth over long periods of time, not just from playing defense forever. So if you're listening to this and thinking, wait, have I been playing it too safe? That's actually a powerful moment, because awareness changes the game. It doesn't mean panic. It doesn't mean throwing money into random trends. It simply means stepping back and asking a better question. Is my money working as hard as I am? That question alone separates passive savers from intentional investors. And once people start asking it, their strategy often shifts in smart ways. Balance enters the picture. Growth assets start playing a role. Time starts working in their favor instead of against it. And over years, that shift compounds into something huge. The key takeaway here is simple but powerful. Safety without growth can quietly become its own kind of risk. Not dramatic, not obvious, but real. So before you label any investment as safe, pause for a second and ask what job it's actually doing in your financial life. Is it protecting money for a short-term goal? Is it stabilizing a larger portfolio? Or is it accidentally slowing down your long-term wealth building? Because that difference matters more than most people realize. And honestly, conversations like this don't happen enough in everyday life. People talk about salaries. They talk about spending, but they rarely talk about the silent mistakes that cost years of financial momentum. That's why sharing ideas like this matters. If this perspective made you pause for a second or rethink how safety and growth work together, drop a comment and say safe or slow. Because I'm curious how many people have seen this mistake before. And if you know someone who keeps hearing that one investment is totally safe, send this video. Their wait might save them years of slow financial drift. Because sometimes the biggest money mistake isn't taking too much risk. It's playing so safe that your future quietly falls behind without you even noticing.